Ladies and gentlemen, thank you for patiently holding. The conference will begin shortly. Please stay connected. Please do not disconnect. Ladies and gentlemen, would like to inform you that there is a video webcast available as well on the company's webpage. Thank you. Ladies and gentlemen, good day and welcome to Samhi Hotels Limited Q2 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashish Jakhanwala, Chairman and MD. Thank you, and over to you, sir.
Thank you so much. Good afternoon and warm welcome to everybody for Samhi's Q2 and H1 FY24 earnings call. Today I have with me my colleagues, Rajat Mehra, who is the Chief Financial Officer. I got Gyana, who is the Executive Vice President and Head of Investments. I also have Nakul, who is Vice President in Investments. And along with my team, we also have the team from Strategic Growth Advisors, who are Investor Relation Advisors. First of all, this is our first earnings call. Thank you so much to all of you for a very warm reception to our IPO. I think for the management team at Samhi and our shareholders, it's a very proud achievement for us to have created a formidable hotel company and all within a period of about 12 years. We have uploaded our result presentation on the exchanges. I hope everybody had a chance to go through the same. But we also have a video webcast where we will be taking you through the detailed management presentation. And we would encourage participants to join the webcast so that they can see the presentation as we take you through our commentary. Given it's our first earnings call, I would spend 4 or 5 minutes to take you through a brief profile on Samhi, our journey, what has been a principal business strategy before we go into details of Q2. Samhi is one of India's leading branded hotel ownership and asset management company. We have a very unique business model that we'll talk about, which is rooted in our ability to acquire and turn around underperforming hotels. As of 30th September, we are very proudly standing as India's third largest owner of hotel rooms by number of rooms. As you can see on the slide, those of you who have joined the webcast, We have about 4,800 rooms across key markets in India, and our hotels span across what we call mid-market segments. We have about 1,500 rooms there. We have about 2,000 rooms in the upper mid-scale, and then we have about 1,000 rooms in the upscale. So the company captures demand at different price points and across key cities in India. One of the most important pillars for our growth actually has been our acquisition and turnaround strategy. We believe that given the low institutional penetration of capital in the hotel sector, there is a huge potential of hotel assets in India which today exist but are underperforming to their true potential. Over the last decade, this has been a moat. We've been able to create a programmatic approach to acquiring underperforming, undermanaged hotels. And invariably, once we've acquired these hotels, we have taken them through a very systematic approach of product, brand, and asset management upgrade, and has seen significant changes to the RevPAR performance of those hotels. So of the total 4,800 rooms that we own today, other than 700 odd rooms that we've built greenfield, rest of the rooms have been acquired through an acquisition and turnaround strategy, and that kind of demonstrates the strength and the success of our principal business strategy. The second important thing for us, of course, is the fact that it has allowed us to grow fairly rapidly. We are very proud of the fact that we've been able to create India's third largest owner of hotel rooms, all within a period of about 12 years. As you know, development cycles in India tend to be fairly long. They tend to be fraught with a lot of development and delay risk. When you're doing an acquisition and turnaround-led growth, you tend to kind of avoid those inherent risks which are there in development. The other key factor for us is the fact that we have a large portfolio. As I mentioned earlier, that portfolio is spread across different price points in key Indian cities, and we have been able to leverage the power of strong global hotel brands which sit on top of our hotels, and therefore those brands are a bridge to the customer. As of 30th September, about 71% of all Holiday Inn Express hotels in India were owned by Samhi. Almost over 40% of all Fairfield by Marriott hotels in India were also owned by Samhi. So even though we partner with a global hotel company like Marriott, Hyatt, or IHG for bringing brand and operational expertise for our hotels, we have a very dominant share of some of the largest global mid-market hotel brands for the Indian market and for Indian consumers. Very proud of our track record. This is a company we created in around FY12. From FY12, when we started the business, the total turnover was just about 1 crore rupees. And in FY23, on a pro forma basis, including the recent acquisition that we'll talk about, we had crossed a revenue of about 954 crores. So this company has really demonstrated what I would consider industry-leading growth rates over the last 5-6 years, even if I was to ignore a very low base of what we had started from about 10 years back. Coming to a recent acquisition that we have made, there will be a fair bit of discussion about Samhi's performance and a pro forma performance. And just to clarify upfront, when we talk about pro forma, we are just making an assumption that that acquisition was made for the full fiscal year rather than for the stub year after closing of the transaction. And it's really important for us because A, that's how we have represented the numbers in our prospectus. And two, when we talk about our total debt today, or what we talk about our future cash flows, it does assume the ACIC portfolio as it has been fully acquired. So this portfolio that we've acquired in August of 2023 consists of 6 hotels with about 962 rooms. It additionally has given us a land parcel in Navi Mumbai for a potential development of about 350 rooms. We believe this acquisition is extremely accretive to Samhi over the next few quarters as we integrate this business with our existing portfolio. Just a quick introduction. I have already briefly introduced a team to you, but Samhi is also a business which is unique in a way that it has been built by a professional management team, and most of the management in this company has been with the business for over 8 to 10 years. Also backed by a very strong board. In terms of governance, we have almost 50% of our board of independent directors. Those directors bring a great depth of experience of different sectors, including hotels, banking, real estate, travel and tourism, and so on and so forth. So we have a since inception, and a very strong independent professional board. In terms of macroeconomics, and we'll give you some perspective of how we see us being positioned in the macroeconomic situation. I think there are two things that we'll talk very often with all of you over the next few quarters. One is airline passengers, and the second is the grade A commercial office space. These are two demand indicators that Samhi has relied heavily to make its investments, to evaluate how our hotels are doing and our underwriting of what our portfolio could be doing in future. If you look at airline passengers, and it's a fairly interesting data point, there's been a lot of anecdotal discussion about how there is a problem of capacity in airlines in India. Airfares are at an all-time high. And if you were to look at actual data for Q2 or even some quarters preceding that, we realized that the total passenger movement on a quarterly basis is just about getting to where it used to be pre-pandemic. So in Q2 FY24, we had about 65 million passengers transiting through various Indian airports. And this number actually is very similar to what the number was on a pre-pandemic basis. So there has been a lot of supply side constraints, but we've barely seen the full recovery of the airline sector. And for us as a hotel owner, asset manager, it's actually a great news because we still feel there's a fair bit of headroom for growth for the airline business in India, because effectively from FY20 Q2 to FY24 Q2, we've really not seen any meaningful growth of total passengers. Right? In terms of office space, India is an incredible market. In the last quarter, which is Q2 of FY24, the key cities in India saw about 22.5 million square feet of total absorption. And that's really some of the highest absorption rates that you see in any global market. No surprises, Hyderabad, Bangalore, Delhi, Pune, Mumbai lead the pack. And as I mentioned to you earlier, we've been following these two data points, and therefore you would see our portfolio largely concentrated and dispersed across markets which are large office markets and large aviation markets within India. And then within those markets, you will see us operating at different price points, starting from a Holiday Inn Express, which is our mid-scale brand, selling at an average rate of about 3,800 rupees to 4,000 rupees. Then going to our upper mid-scale brands like Fairfield Marriott and 4.5 Sheraton. And then eventually in core markets, we have upscale and upscale with brands such as Hyatt Regency, Sheraton, Courtyard, Sheraton, and Renaissance. In terms of our Q2 performance, and now we'll just quickly jump to Q2, so we leave a lot of time for Q&A. During the last reported quarter, the company reported an occupancy of about 72%. So all of our 31 hotels, the aggregate occupancy was about 72%. Our average room rate, and we will caution the audience that the average room rate in our portfolio is a weighted average of 3 different segments, and therefore you would sometimes see some noise in the average room rate. So there will be a lot more focus on average room rates for each segment. But a portfolio-wide occupancy was about 72%. RevPAR and ARR both grew in the range of about 16.4 and 14.7% respectively. Rajat will take you through the financials later, so I'll skip that part. In terms of growth, last year, same quarter, we did a total revenue of about 176.4 crores. What we've seen is about 14.6% growth for same-store assets. And then we have an impact of the recent acquisition that we've made, resulting in a total revenue growth of about 25.3% year-on-year. Similarly, in EBITDA, last year, same quarter EBITDA was about 62.5 crores. We've seen about 19.2% year-on-year growth on same-store. And then there's an impact of about 8.8 crores from the acquisition of ACIC. Therefore, the total EBITDA at an asset level is being reported to grow at 29.8% year-on-year. RevPAR, which most of the participants would know is a very important indicator for our business. We've seen really healthy growth both in Q1 and Q2. We saw about a 14% growth in Q1. We've seen that improve to about 15%. Early indications confirm to us that this RevPAR growth continues through the current quarter. I think there are really an enabler and sometimes something that always pull you back. In the last quarter, the enabler was really the fact that we've seen really no new supply coming in our core market, and the demand for business travel continues to remain very, very healthy. No surprises. 22.5 million square feet of office space was absorbed in India in one single quarter. So that is what is driving the RevPAR growth. We actually could have seen a better quarter, but for the fact we saw some negative impact in Karnataka because of the Karnataka Bandh towards end of September. As you know, we have a reasonable presence in Bangalore city, and two, also we had certain apartments which we had taken for some upgradation in Pune. And therefore, if we had these two incidents were netted off, we would have seen probably a higher RevPAR growth and net impact on total income and EBITDA. Every quarter, we are very proud of our in-house and proprietary asset management tool that we've built, which we call Samhi Intel. This tool uses really high frequency daily data to identify trends which can have a potential impact, positive or negative, on our performance. It's one of very unique asset management tools, perhaps in the industry today. And every quarter we'll give you one insight from that tool, and so that the information asymmetry between management and investors is kind of removed over a period of time. This quarter, one of the things that we have identified is what we call demand compression. How many days in a year the portfolio is achieving a very healthy occupancy. And if you see in the current calendar year, and I'll repeat current calendar year, so from 1st Jan till literally day before yesterday, we actually saw that our entire portfolio had achieved more than 70% occupancy on almost 60% of all days. And that's a really healthy trend given the fact that we're heavily based in business locations with business hotels. So including the impact of weekends and holidays, we saw 70% occupancy being crossed on almost 60% of all days. But more important is the fact that almost 1 in 4 days, our portfolio was doing more than 90% occupancy, which is when we realized that we can really yield our assets to our advantage. So this is just one insight. In terms of segments, we have 3 segments, as I articulated earlier. Starting from the lower end, we have mid-scale. We have a singular brand there, Holiday Inn Express. Then we have upper mid-scale, which we have 2 brands right now, Fairfield and 4 Point by Sheraton. And then in the upper upscale and upscale, we have different brands with 5 hotels. We'll quickly take you through what we've seen as performance trends in these segments. We have seen RevPAR grow in excess of 7% almost in all 3 segments. Even in the upper upscale, we've seen RevPAR grow in excess of 7%. There's a fair bit of upcoming growth coming within the segment for us, which includes we're adding some inventory to our Hyatt Regency in Pune, including a restaurant. We have an in-principle agreement with Hyatt to renovate and rebrand Hyatt Regency in Pune. We are also looking at improving our market share in social events in hotels in Pune and Hyderabad through refurbishment of our banquet facilities there. And then, of course, we're launching about 45 refreshed executive rooms at Sheraton Hyderabad. So whatever performance we see today, you will see a significant upside because of the operative action that we're taking in the business. Similarly, in the upper mid-scale segment, we've seen RevPAR grow in excess of 7%, both in H1 and in Q2. And again, in this segment, we expect, first of all, the biggest advantage will come from integration of the ACIC portfolio, which is 962 rooms. We were starting to do the planning of the 350-room hotel in Navi Mumbai, but that's really a long lead delivery. And then over the next year and a half, we'll see the renovation and rebranding of Caspia Delhi and the 4 Point by Sheraton in Pune. The higher than 7% RevPAR growth trends continue in mid-scale assets, where we've seen good performance. This segment also will see a new hotel being added sometime next year in Calcutta, which is 116 rooms. We'll see a 56 rooms addition to our Holiday Inn Express in Bangalore Whitefield, and we are going to undertake a renovation of an existing hotel in Greater Noida, which will then reopen as a Holiday Inn Express. All of this is targeted to be done in FY25. In terms of our strategic initiatives, I think we've classified them in 3 buckets: operative, financial, and growth. In terms of operations, clearly, a simple low-hanging fruit for us is our portfolio is in markets which have the largest office space and airline business. We can leverage that for our benefit. The integration of the 962 rooms of ACIC will bring tremendous advantages to our overall portfolio in terms of margin improvement and revenue growth. In terms of financial target, Rajat will take you through how we have transformed the balance sheet through the IPO proceeds, but we are moving fairly quickly towards our commitment to get net debt to EBITDA around 3.5 times by end of FY25, alongside bringing reduction in the financing costs. And growth, some of the growth targets which are immediate, we've already spoken about when we spoke about each segment. This is just a roadmap of our various growth targets over the next 2 to 3 years. And as I mentioned earlier, all of this growth is internal to the company. No acquisition needs to be made, but we're fairly confident that of the 4,800 rooms that we have today to ourselves, about 3,900 rooms are stable, same store. About 900 rooms are undergoing some renovation, rebranding over the next year, 2 years. And then we have the ability to add 600 rooms to take our portfolio to about 5,400 rooms. All of this will be delivered over the next 2 to 3 years. Rajat, I'll now pass it on to you for financial results.
Thanks, Ashish. Good afternoon, ladies and gentlemen. I will take you through the financial performance of our company for Q2 FY24. During the quarter, we completed the acquisition of the ACIC portfolio on the 10th of August 2023. As a result, our financial performance for the quarter includes performance of ACIC portfolio as well. Our asset income for the quarter has increased to 2,211 million in Q2 FY24 from 1,764 million in Q2 FY23, registering an increase of 25.3%. Our asset EBITDA for the quarter has increased to 811 million in Q2 FY24 from 625 million in Q2 FY23, thereby registering an increase of 29.8%. The consolidated EBITDA pre-ESOP and the one-time expense has increased by 29.7% to 739 million from 570 million. Overall, our estimated ESOP cost for the year is about 460 million, which is being amortized over 4 quarters. And that's why you see very similar expense coming in quarter 1 and quarter 2 of current financial year. The other one-time expenses are completely charged off in the P&L, and we don't expect these to incur in the coming quarters. Our depreciation for the quarter is higher as compared to the same quarter last year due to the inclusion of the depreciation related to the ACIC portfolio. Our finance cost for the quarter is actually not a true representation of our ongoing interest costs, as we have not been able to use our IPO proceeds and reduce debt to the extent that we have planned in the current quarter. Significant part of the high-cost loans were actually paid post the quarter end, and you will see the reduction in the finance cost in the subsequent quarters. Also, the finance cost in the current quarter includes some one-time exceptional costs of close to about 250 million.
Thanks.
On our balance sheet, if you see post the IPO, we've been able to improve our financial strength. Our net worth actually has turned positive to 10782 million from a negative of 8076 million, and primarily due to the IPO and as well as the all-stock deal that we did for acquisition of the ACIC portfolio. On the operating efficiency, our overall EBITDA for the portfolio is 37%, while the EBITDA for the ACIC portfolio is only 32%. We are confident with the completion of the integration of this portfolio with Samhi. The asset EBITDA margin of this portfolio will also improve closer to that of Samhi's similar segment. On the overall debt, we have been able to reduce our net debt from about 28,339 million as on March 31st, 2023, to a net debt of about 18,333 million, registering a reduction of close to about 35% here. If you see on a current trading 12-month basis, our debt to EBITDA has considerably reduced to 5.4 times as compared to that of about 8.7 times as on March 31st, 2023. With the reduction of overall payments that we have made for reducing the overall debt, we have been also being successful in reducing the cost of borrowing. Although we have talked about the cost of borrowing about 10.49% in the presentation here, but I'm happy to inform that it is actually further reduced to about 10.42% by actually paying certain bit of high-cost debt after the release of this presentation. With that, I actually pass the presentation back to Ashish.
Thank you so much. That's from our side. We are happy to take questions now.
Samhi, we open the floor to questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. For the participants who have logged into the webcast, you can click on the audio question button to ask a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Jaiveer Shekhawat from Ambit Capital. Please go ahead.
Thanks for taking my question. And Ashish, congratulations for your maiden earnings call. So Ashish, my first question is about your overall portfolio, given that you've blitzscaled this portfolio in the past. So apart from the Navi Mumbai land parcel development and also the plans that you already have of sort of adding more rooms, are there any other plans over the next 3 to 4 years in terms of acquiring any further assets, or would you still focus on just growing and integrating the current portfolio?
Jaiveer, thanks. So I think we will just like to take you through prioritization. I think our priority is to ensure we deliver on what we call internal growth targets. So from where we are today, Jaiveer, we have 4,800 rooms. About 900 of those rooms need to undergo a significant renovation and rebranding. We have seen from our past track record that renovation and rebranding creates a significant upside in the performance. That's one. Second, we need to add about 600 rooms to our portfolio, which is all for which real estate is currently owned by the business. So I think in terms of priority, we are focused on these two internal growth levers. In terms of medium to long term, we constantly look for interesting growth opportunities. As you know, a part of our portfolio, especially in the mid-scale space, is long variable leases. We continue to find interesting opportunities for local landowners to come to us for long variable leases, which is also extremely capital efficient. And if there is a very interesting long lease opportunities in a tier 1 market, we shall respond to that opportunity. But again, I repeat, our priority is to focus on our internal growth project.
Right. This is very clear. Thanks. And secondly, on your ACIC asset level margin, so when do you expect that to catch up with the rest of the portfolio level margins? And if you can also detail the process that undergoes in terms of doing that turnaround.
So, Jaiveer, there are really 2 or 3 steps to doing that. The first, that portfolio currently is on a franchise basis, which means the resident management team is also looking after the hotel operation. Our first target is to convert those franchises to management contracts. And by doing that, these hotels start benefiting from a broader distribution sales support system from Marriott. Second, we have a very large portfolio with Marriott hotels, and because of which we run a shared services center. That shared services center effectively works like a mothership for all Marriott family branded hotels. And we have started integrating these hotels with our shared services center. So combination of franchise to management, and second, these hotels getting integrated into our shared services center will help us get the margins to expand from current circa 32% to at least 37-38%, which is where we see our portfolio. I think the margin will start getting reflected from first quarter of next fiscal year, but every quarter you will see a graded improvement, but the real impact will be really Q1 of FY25.
Sure, I think that's very clear as well. And now, more in terms of about the net debt to EBITDA levels. Now, I see that you've targeted less than 3.5 times by end of 25. But just more calculated guess, so if you were to target a net debt to EBITDA of less than 2 times by, let's say, FY26, what kind of RevPAR growth would that imply for your portfolio?
So, Jaiveer, there is really 2 things which will help us get to a desired debt to EBITDA level. One, of course, is growth in income. And the other also is a consistent reduction in our leverage. In terms of growth in income, again, I will break it up for 3 parts. There is an existing same store, 3,900 rooms. And as we've disclosed, they have been growing at a RevPAR of about 14-15% in the last 2 quarters over the last year. We will obviously talk a lot about demand supply, but we see little resistance in terms of demand and supply for RevPAR to continue to grow in that zip code. So that's one. Two, you will see significant improvement in the margins coming through from the ACIC portfolio. Three, you will see that we have some low-hanging fruits in terms of the additional inventory. So for instance, the hotel in Calcutta, the new inventory in Bangalore and Pune, these are all ready buildings. Substantial capital has already been invested in these buildings, which is a part of our current net debt in a way, right? And as we operationalize these hotels over the course of the next 6 to 8 months or 12 months, you will see incremental EBITDA coming from those assets as well. So you combine all those three together to get to, I mean, you ask FY26, you have an EBITDA which has grown exponentially from where we are right now because of a combination of these three things. And on the other hand, we are seeing consistent reduction in leverage because from quarter three, we have free cash with us, right? And because of that free cash, a part of that free cash is going towards funding the capex that we have to do for capacity expansion and renovation. But a part of that free cash is going towards constant reduction in leverage over the next 2 years. So combination of two, they will converge together, and that's why we are fairly confident about bringing the net debt to EBITDA down to about 3.5 times by end of FY25.
Sure. And lastly, my question to Rajat. So Rajat, if you can just specify what are these one-time expenses for which you have also incurred last quarter? And also, if I see your 4Q FY23 RevPAR, and there was quite a jump there. So are there any one-offs due to any asset addition, or do you still believe the growth can be still around, say, the levels that you have been talking over the last 2 quarters?
So I'll take the first question. The one-time expenses that you see, predominantly includes two parts to it. One is there were some one-time bonuses which was released that was actually committed to the team last year, but because of the cash flow, we did not release it last year. These were actually released this year, so that's the one-time expense. This has been charged off in quarter one and quarter two. The second bit of large expense there is the money that actually has been spent in the dual portfolio, in the ACIC portfolio, because they were actually also doing a lot of work, primarily for the IPO, by way of the certification that has been done. Their audit was to be conducted, but since they were part of all the statutory, we couldn't actually net that off from the IPO proceeds, and that necessarily had to be charged off to the team. So these are the two one-time costs that were actually are able to be in the now.
Yeah, and also, Jaiveer, just to clarify, the ESOP expense that we are currently seeing at about 11.5 crores per quarter, which is, as Rajat said, about 460 million or 46 crores for FY24, it will materially go down to just about 17 crores for the entire year, next fiscal year. And subsequent to that, it will go down to barely about 95 million or 9.5 crores for the year after that. So not just the one-time expenses, which will not repeat from quarter three onwards, but after FY24, there will be a significant reduction also in the ESOP expenses, which are currently reflected.
Sure. And any comment? Yes.
Sorry, Jaiveer.
No, I mean, just on the comment there, because usually the third quarter is a stronger quarter versus the fourth. But we have seen some increase for all the other hotel chains as well. But then the kind of increase that we saw in your RevPAR from 3Q to 4Q, that was quite significant. So any comment here?
Jaiveer, the line was not very clear.
I think that quarter 3, quarter 4 RevPAR growth, you are asking, and we couldn't talk about it here.
That's right. So were there any kind of one-off due to any asset addition or anything that we should be aware of?
No. So what you're seeing as RevPAR growth that we've reported for quarter 1 and quarter 2, it does not have any bump up because of any non-business, non-recurring travel issues. Even just to clarify, the net impact of World Cup, for instance, was barely 1.5%-2% in the quarter. So the RevPAR growth is coming all because of the very strong, sustainable business travel demand and really no threat coming on the supply side. And therefore, we've really not seen anything being added. And the RevPAR growth, actually, the 14% and 15% is on same store. Slide number 10. Same.
So actually, if you can just clarify on fourth quarter of last year, I think my question was relating to that. If I see from third quarter of last year to fourth quarter, I think there was a substantial increase. So just trying to understand that.
No. So quarter 4 is the best quarter. Okay, so on a daily run rate basis, quarter 3 and quarter 4 are very similar. But just the fact that quarter 3 tends to have a lot of holidays. So you'll have Dussehra, you will have Diwali, you have Thanksgiving, and then you have Christmas and New Year. So if you look at the business travel tends to accelerate towards the H2. But within H2, while a daily revenue run rate is pretty healthy even in Q3, as it is in Q4, but Q4 has a unique advantage that once people come back on 5th or 6th of January from their New Year break, from then till 31st March, there is no interruption because of a large holiday. So therefore, we've always seen quarter 4 to be a strong quarter, and there was really no any other special event or one-time issue that bumped up the RevPAR from 3,600 to 4,200.
Sure, that's very helpful. Wish you guys all the very best. Thank you a lot.
Thank you so much, Javier.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. For the participants who have connected through the webcast, may I request you to click on the audio question button to ask a question. Thank you. Our next question is from the line of Dhruvesh Sanghvi from Prospero Tree. Please go ahead.
Yeah, thank you for taking my question. Am I audible? Because I'm slightly in the middle of noise and I'm sorry for that.
Yes, you are audible. You're audible.
Yeah. So Ashish, I just wanted to understand how do you think about returns in this business? Considering, I mean, do you think from a payback perspective or a ROE, ROC perspective after the assets mature in 3 to 4 years? Some of your thoughts on how you think about these assets in general.
So there are really 2 measures that we deploy for ascertaining the return. One is NOI yield, which is nothing but EBITDA over total invested capital. And second is the traditional ROCE, which I don't need to explain, right? Now, typically because of high depreciation in the first few years, we've seen the NOI yield give a true representation of the real, I would say, efficiency of capital deployment. But honestly, after 5, 6 years, we've seen NOI yield and ROCE starts to trail each other because, the depreciation has been adjusted on both sides. What we've seen in our portfolio so far is that even though people believe it's an asset-heavy business and therefore tends to be poor ROCE, but we've actually seen that if you've made the investment in a capital-efficient manner, and, I know there's a lot of debate about asset-light versus asset-heavy, but so long as you maintain capital efficiency, you can actually get anywhere between mid-teens to high teens of ROCE. It also depends on market cycles. So for instance, we look at our portfolio. By the end of FY24, what we see is a large part of our stable portfolio, 3,900 rooms, which does not need any renovation or rebranding, will be in the zip code of about 15-16% ROCE. But within that portfolio, if you look at a Bangalore market where the rates have really gotten to being really healthy, you will see ROCEs being in early to mid-20s. So we've actually seen a very healthy trend where good investments in this business can allow you to create at an early stage mid to high teen ROCEs, and as the rates mature, you can get to early to mid-20s.
Sure. And in connection to that, additionally, so when basically the idea is that once it matures, we are talking about a 15 to 18% number. Now, considering the kind of cyclicity that hotels in general sometimes face over a 5 to 8 year period, isn't it, how should we think that, in a good year, we will do a 15 to 18 5-year cycle, but then it may be followed by a bad cycle. And then how should we think over a 10-year investing journey? Suppose if we are invested with Samhi or any other hotel player, just your thoughts. And I've almost read all your podcasts and TV interviews starting back till 2012, and you have amazing insights and the way you think, and I really appreciate the way you generally challenge your industry quorum also. And so that is why I want to probe your mind around this topic.
So let me clarify. You should be able to get 15 to 18% average ROCE if you are in a volatile 10-year cycle. When I mean volatile, in the old times, Ramesh, we were told 2 good years, 2 shoulder years, and 2 bad years. Okay, so that 6-7 year cycle was very easily split into one third, right? So there are a couple of things we need to keep in mind here. When a city or a market gets to really healthy performance, I won't be happy with mid to high teens. Then I would be greedy to see mid 20 ROCEs. So our Bangalore city ROCEs will be sitting at about 24-25%, right? Hyderabad is getting upwards of 20% right now. So just to reiterate, a good cycle should deliver an investor that early to mid 20 ROCEs. An average cycle is where you should be in that zip code of 15 to 18%, right? Now let's come to quote unquote a bad cycle, right? I think there what is really important is what is your fundamental business model. And that really goes down to what segment you're operating in. And we have seen that typically mid-scale hotels, because the capital investment in them is relatively lower. Second, the price points at which they sell, the delta drop that you see in them sometimes is not as significant as you would see in luxury or upper upscale hotels. So we've seen that typically mid-scale hotels provide you a reasonable safe haven for a drastic drop in ROCEs in such bad cycles, right? But just to reiterate, good cycles, please don't ever be happy with any management. If in a good cycle they're giving you a mid-teen, in a good cycle they should give you 20s, in an average cycle mid to high teens. But what is very important in all of this is to understand cycles. And I know it's a bit of a crystal ball gazing, and it's really difficult to talk about the past. But Steve Jobs very famously said, you can never connect the dot in future, you can always connect the dots in the past, right? So if you try and connect the dots right now, the demand-supply equilibrium in India is more clear than I've ever seen it before, right? And therefore, as we invest in this sector, as we grow our business, as management, as investors, we need to have a high degree of confidence about the fact that we have several years to yield this business before we potentially see a supply threat, and only a supply threat can disrupt the party. Because the demand in a country like India, trust me, we don't need to question each other for the next 2 decades. And it's never an easy answer, Dhruvesh. So I'm sure I'm not giving you 100% answer here, but that's my best effort.
No, I completely understand, and I really like the way you describe it. Thank you. Thanks a lot. And one more additional aspect, in the just before the IPO, a lot of TV interview you did, you talked about pro forma EBITDA. I actually am forgetting the number. Was it 311 crore that you were mentioning? Am I right, or 411? I'm actually confused a little bit. But the pro forma EBITDA considering the ACIC portfolio, so what should be the pro forma EBITDA estimate, if you can give us for FY24 without the margin increase coming from ACIC?
So a few numbers will give you. So you're absolutely right. The pro forma EBITDA for FY23 was 327 crores. And there was some one-time expenses that finally reported was 311 crores. So you're absolutely spot on. Without really going to FY24, I'm a reluctant forecaster, I must tell you this. But I can explain to you where I see the business headed. If you see my trailing 12 months, we have already achieved an EBITDA of about 340 crores, right? So this 340 crores includes Q3, Q4 of FY23 and Q1, Q2 of FY24. Two, we have actually seen same store EBITDA growth of about 20% in Q2. I will again repeat the fact that we are not seeing any evidence of there being a disruption to the EBITDA growth in Q3 and Q4, especially in view of the fact that we just highlighted that Q4 is really a really strong quarter. So we have already reached about 345, 350 crore EBITDA. We've been seeing a 20% growth in the first Q1, Q2. That's all I can say for now. As I said, I'm a reluctant forecaster of my own future. So you'll have to live with the facts I've given to you about the past.
Sure. That's helpful. And last question, and I'll come back in the queue, is what is the kind of capex that we require for refurbishments of rooms, and how often in the cycle of a hotel do we have to see this as a
how should we assume these numbers in the future?
So, so first of all, for our portfolio, when we talked about the 900 rooms renovation and rebranding, we are allocating about 125 crores of total capital expenditure for that. But I think your answer is different. Your answer is more about recurring capital expenditure for maintenance.
Yeah.
So there you see we almost take about 5% of our top line, 4 to 5% of our top line, which would almost range 40 to 50 crore in our P&L. So substantial amount of money is being spent on an annualized basis to maintain properties in a fairly good state and therefore preventing any one-time major capex. In addition to that, we typically provide for an additional 2.5%, which would go in form of an extraordinary capex, but that does not go on an annualized basis. That goes at a periodic basis. Third, just to explain to you why that is adequate, it really depends on the sector you're operating in, right? What we have seen again, that suburban business hotels tend to have the least capital reinvestment cycle relative to leisure hotels or luxury hotels, right? And that's largely because both in leisure and luxury hotels, the proportion of the FF&E spend is much higher than the proportion of the FF&E spend, which is furniture, fixture, and equipment, in a mid-scale hotel. And that's the item that gets depreciated in 7-8 years, whereas building, engineering, all of that has a really long shelf life. So we have already provided for, and we have been expensive about 40 to 50 crores a year on maintenance capital expenditure before we report the EBITDA to all of you. And in addition to that, we would provide for about additional 2.5%, which will be in the reserve code of about 20 to 30 crores of additional capital expenditure. That's more a reserve. That will go from our current cash or future cash flows.
Right. So okay. From another parameter, let's say if we have, I think we always speak about 1 crore per room as the cost to us. From that angle, then can we say that it is a 5 lakh rupees cost per room per year? On an ongoing basis, or I know I can convert it later from what you said, but if we think it from this angle, is it the correct way to think?
I'll use our own numbers. Our total capital expenditure per key in our portfolio was 72 lakhs per key. But that actually included land cost as well, right? So we've only over the last 12 years spent about 72 lakhs per key, including land, right? And if you eliminate, let's say, hypothetical, because we buy existing hotels often, so it's difficult to separate land from building. But if you take a hypothetical 20% towards the land, then you're barely talking about some 55 lakhs per key is the total capital expenditure. No, you don't have to take a 10% of that or a 5% of that. As I mentioned earlier, FF&E expense in that 55 lakhs will barely be about 10 lakhs or so per key. And that 10 lakhs per key needs to be amortized over a period of 7-8 years, really. So that's how your FF&E spend on an annualized basis comes to be really a pittance.
Thanks a lot. Thanks a lot, and I'll join back in the queue. Thank you.
Thank you so much.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask a question. Participants who are connected from the webcast, to ask a question, you may click on the audio question button. Thank you. Our next question is from the line of Pradyumna Chaudhary from JM Financial. Please go ahead.
Yeah, hi, sir. So you mentioned that out of 4,800 rooms, 900 will go for renovation. Can you please highlight the timeline for this? When would these rooms go under renovation, and by when do we expect them to have expect us to have these rooms back into our inventory?
So the renovation and rebranding of the Holiday Inn Express in Calcutta, Calcutta is a new build actually. Renovation rebranding of Caspia Pro Greater Noida is going to be completed in FY25. The renovation and rebranding of the High Frequency in Pune and 4 Points in Pune will be done by FY26. So that's really the target that we have for key renovation rebranding. So Delhi, Greater Noida by end of FY25, and both the hotels in Pune sometimes in FY26. But what is really important to note here is the assets like Delhi and Greater Noida today have negligible contribution to our total EBITDA. And therefore, as we take them through renovation and rebranding and these hotels open next year with a fresh brand and a new product, their entire EBITDA of those hotels will be effectively a delta over what we're doing right now. In terms of High Regency Pune and 4 Points by Sheraton Pune, the large amount of our renovation and rebranding is about soft furnishing and change of look and feel. The hard infrastructure and product is pretty good. And therefore, just to clarify, we don't actually anticipate any significant disruptions to the business as we take this hotels through renovation and rebranding.
Understood. And apart from these, I think you mentioned that there are a couple of assets which are ready but are not really contributing to our numbers right now. Can you mention those ones?
So yes, we have the Holiday Inn Express in Calcutta. It's a 111-room hotel. The hotel is currently starting fit-out, and therefore this should be ready in FY25. Clearly today that hotel is non-operational. Then we have a really well-performing Holiday Inn Express in Bangalore Whitefield. We are adding 54 rooms to that hotel. Again, the building is completed. We are starting the fit-out. Similarly, we are adding anywhere between 16 to 31 apartments, service apartments in our High Regency in Pune. Again, in that particular instance, the building is completely ready. We have to start the fit-outs there. So these are 3 additions which should happen, which are targeted to be completed before FY25, because in all of these cases, substantial part of the work has already been completed.
Understood. That was really helpful. Thank you and all the best.
Thank you. Our next question is from the line of Raj Joshi from Ace Securities. Please go ahead.
Thank you, sir, for the opportunity. Sir, I have only one question. What is the difference between asset income and reported income, and also asset EBITDA and the reported EBITDA?
The asset income actually includes income which is generated specifically from the hotel. Besides that, there is some bit of other income also that we have in the nature of fixed deposits and certain Indians, and also we have a small bit of a commercial drop that we have. That's the rental income of that also is a part of the other income. So if you add all of this put together, is the total revenue.
And similarly in EBITDA, each hotel reports in EBITDA at a property level. When you add that together, you get to what we are reporting as asset EBITDA, which tells you the performance of the actual business. Then from that, we adjust net expense towards corporate and administration, which is any interest income or salaries, wages, travel for the corporate office overhead. That gets you to the reported EBITDA pre-ESOP and one-time expenses. So the difference between asset EBITDA and EBITDA is really the reduction of corporate G&A and any income at a corporate level, largely in form of interest from investments.
Okay, sir. So that's it from my end. Thank you.
Thank you. Our next question is from the line of Giriraj Daga from Visaria Family Trust. Please go ahead.
Yeah, hello, sir. My first question is related to what percentage of business in a normal year comes from the contract, which we let's say sign for an annual contract with corporates, and what percentage is spot market?
Okay, so in terms of contribution, about 34% of our business comes from what we call special corporate. About 47% of our business comes from retail. 13% will be group and MICE, which is meeting incentive conferences, and 4.5% is airline through. So that's the big breakup. About 34% special corporate, 47% retail.
Understood. So the negotiation cycle is basically January to December, right? So the negotiation for the next cycle must be underway right now. What are the feedbacks you are getting on the ARR for the next year?
So if you were to see this trend over the last several years, you'll actually realize that 34% special corporate is not very high. And that's largely because given the fact that all hotel companies are fairly confident about simple demand supply. They don't need to necessarily rely on a fair bit of upfront contracting. But you're absolutely right. The contracting for the RFPs, as we call them, for the next year start now. We are seeing a reasonable acceptance in the market about accepting a price increase. And I wouldn't also be surprised because these are the same customers who are flying, taking an airfare, which have skyrocketed almost 2x or 3x. So today, if we fly from Delhi to Bombay, we're trying to book some tickets for 2 weeks from now. It's 19,000 rupees one way for premium economy. And when those guys land in Mumbai, if they're supposed to pay 12,000 rupees for a hotel for the next 24 hours, I would like to believe the resistance will not be very high. So we are seeing a reasonable acceptance of the fact that there is a demand-supply equilibrium which is working, and therefore people are accepting reasonable rate growth even on corporate contracts.
Okay. My second question on renovation and rebranding. Like, what normally, like, how many quarters will we be able to have to lose this business? Like 2 quarters, 3 quarters?
Oh, no. So typically in our existing hotel, and we've done multiple times these renovations, what would happen is that the hotel will keep operating as is. The renovation will continue because there are areas that need to be renovated. And the real interruption is literally for just a few weeks when you need to effectively, let's say, take the reception lobby or the elevators under maintenance, right? I'll give you an example of this. So when we started talking to our partners at Hyatt about potential upgradation of the Hyatt Regency, there was a product improvement plan given to us, which included multiple areas. And we are happy to inform you that of those multiple points that we had agreed with Hyatt, many of them have actually been complied with while the hotel has been operating, and that includes addition of a 18,000 square feet of meeting space that we call EQIQ, a complete renovation of an existing restaurant that we relaunched as Zeta. We have upgraded the existing rooms. So we don't, as I said, we don't expect a meaningful, and typically that last few weeks of upgrade is done in weeks that typically the business tends to be really poor. So on an ongoing basis, we don't expect material interruption to any business because of the proposed renovations and rebranding. And in any case, 2 of them, their contribution to our earnings is negligible, so there is effectively nothing to think.
No, but we will have fixed cost to be absorbed, right? That is also going to hurt us.
Yeah.
So, my last thing is that what percentage of, let's say, contribution you got it from the foreign, basically customers.
Oh.
And what was the that percentage in FY20 normal year prior to COVID?
So in last quarter, we were 79% domestic and 21% international. Also, I'd like to highlight the fact that we have a large portfolio of mid-scale and upper mid-scale hotels, which any case have a significant business coming from domestic sources. But if we were to separate the upscale segment, we've actually seen the international business just barely recovering to the pre-pandemic levels. Just to give you the exact data, just give me 10 seconds. It used to be about 42% in the upper upscale space in quarter 2 of 2020, and that number today is at about 37%. So from 42 to 37%, there's still about 5 percentage point gap in terms of contribution from international business travel.
And you agree that once that number goes back to normal, the ARR effect will also be visible, right?
Yeah, and we have seen historically the international business was coming at about a 30-35% rate premium. We have been seeing quarter-on-quarter improvement in terms of contribution of international business travel to total business. So you're absolutely right. It's a latent opportunity. Every quarter we've seen some recovery. So without the broader market really shifting, this 5 percentage point improvement in the room nights being sold to international business will have an impact on the weighted average room rates.
Sure. Thanks a lot.
Just to give you data points here, the domestic rate is about 7,200 rupees today, and the international rate is about 9,900 rupees. This is only in the upper upscale segment where we see a larger contribution from international business. So that's really the delta between domestic and international.
Sure.
Thank you, sir. Our next question is from the line of Dhruvesh Sanghvi from Prospero Tree. Please go ahead, sir.
Sir, just trying to understand a little bit about the history.
Sir, may I request you to use your handset, sir? Your audio is not very clear, sir.
Is it better?
Yes, sir. Please go ahead.
Yeah. Just trying to understand a little bit of the history. So, you mentioned that dots can be connected only from the past. So what are the learnings 2012 to 15 period and started collecting these assets? What did not work out well, and what were the learnings that you have adapted for the future whenever you do? And I'm not considering this COVID-led problems because that was completely unimaginable. So I'm not looking at answers from the COVID learnings because that could be around the leverage area, which you have actually survived very well. But I would try to understand from you how you think about the past decade and what were the assumptions that went wrong, or where were you aggressive in your assumptions, and some thoughts around that. Thank you.
Yeah, thank you so much. So I can highlight 2 or 3 big lessons, right? One is the lessons in the market. And what we've learned is that for a company like ours, we do find a safe haven in tier 1 markets. And I don't want to be misunderstood that we don't believe in tier 2 markets. We do believe in the strength of the tier 2 and tier 3 market. But purely in terms of risk reward, we have seen tier 1 outperform tier 2 by a large margin. And we've been thinking if that was just anecdotal, it was just a small blip in a long cycle, or there is a statistical evidence for that risk reward. And we've actually been able to isolate that. What we've realized is that let's take 2 extreme examples of markets. In a market like Bangalore, today we have about 22,000 odd rooms operating in different branded categories. This is a market where we've seen office space grow at about 3 million square feet a quarter. Circa growth rate on an annualized basis will be about 8 to 10%. We've seen the airline business in Bangalore also grow in the same zip code of about 10 to 12%. So fundamentally, all demand indicators are leading to a growth of 8 to 10, 12%. For the supply to keep pace with demand growth, they need to add, or they need to open 2,200 rooms a year in that market. And we just don't see that happening because it's a fairly large inventory to be added every year, year after year for the next 4 to 5 years. So what we are seeing in tier 1 market is that the demand has really left the supply by a large margin. And now the supply is finding it difficult to catch up with demand. And therefore, you tend to see more stable performance in these cities. Let me take another extreme example, and I will not say a city's name here because all of us have hotels in different cities, and I don't want to necessarily talk poor about any market. But there's another city, B, which is not a tier 1 market. Their total inventory today is, let's say, 1,500 rooms to 2,000 rooms. Demand growth is yet there 10, 12%. I'm not questioning that. But the bigger problem is for the supply to grow at 10% to keep pace with demand, they barely need 150 to 200 rooms. So therefore, in those markets, we are a little anxious about seeing a repetition of what the core market saw between 2008 and 2018. So let's not forget, 8 to 18, India was never oversupplied. It is just that India had 50,000 rooms, which grew to being 150,000 rooms. And therefore, that period did not allow the sector to perform to what we all expected it to. We fear that some of the tier 2 markets may again expose you to that low supply base, and therefore on a low supply base, adding incremental supply of 10, 12% is not that difficult. So that's one lesson, that if you want to have a reward matrix, tier 1 give you a good place to invest your capital and have your assets. And the good news really is there is more and enough opportunity for you to grow in tier 1. And that's, by the way, it's just because of the size of the office market growth and airline growth in those markets. That's one lesson. The second lesson that we learned, and this is very peculiar to our business, is we started by saying we buy underperforming, undermanaged hotels. And we typically will acquire those hotels, make significant changes to the product, bring a strong brand, and because of that, we've seen the performance really transform, often 2x, 2.5x on RevPAR. Right? One of the lessons we had was in some of the instances, like 4 Point Vizag or 4 Point Ahmedabad, right? We decided to defer capital expenditure in stages. So for instance, we'll say, we'll do public areas in 1 year and we'll wait and do guest rooms in second or third year. What we've realized is for customers, it's either a complete product or it's an incomplete product. The customer is not interested in your first chart about saying, I've done 40%, they will not give you 40% higher rate. So till such time you don't complete your renovation program, do not expect the markets to reward you for your underwriting, right? That's the second lesson. And the third lesson is F&B is a lot of hard work, you know, and I'm not trying to say that we will not do that hard work, but what we've seen is incremental returns coming from the room business are outstripping anything we can get from food and beverage business. And I'm not talking in terms of revenues, I'm talking in terms of net contribution margin from that business. So we've seen the competition from standalone F&B outlets, both in terms of quality, ease of access, pricing, and their cost structure is really something that as a hotelier, I would find difficult to compete with on an ongoing basis. So if I was to really summarize our top 3 learnings, it would be tier 1 versus tier 2. Don't be cute about deferring renovations. And third is really about F&B. Having said that, I know you've been gracious by saying, let's not talk about COVID, but for a company like ours, it is important. And I think there are lessons in that as well, right? And one of the lessons of COVID is this industry needs to fundamentally transform its cost structure to increase the ratio of variable cost to fixed cost. Because see, what happens I'm not worried about pandemic happening again or a response to pandemic being so severe again across India for all of our hotels. But we have also to be prepared, one hotel going through a period of turmoil. It could be because of a metro rail construction in front, it could be because of a local unrest, and so on and so forth. We've learned a lesson that it is going to be helpful for the sector and definitely our business to move from a high fixed to a low fixed, but transfer that to a variable cost structure. We aren't yet there, but that's clearly a path that we want to walk. And that's why I would say that COVID is not something we'd like to ignore. COVID is something that we've got to take some lessons from really.
Wow, thanks a lot about all this. And just around this topic, you had also, somewhere I think in my reading I understood that it is almost impossible considering the cost of real estate or the cost of construction and the land. It is almost impossible that anybody can offer a decent quality room below 3,500. Is this metric correct, number one? And number two, if this is so, on the other hand, when we talk about, constant increases in RevPAR or, average room rates, but the kind of market that we are as a country, can we really absorb a 10% increase or 15% increase for 5 years? Isn't it a little bit of too much of positivity building in?
Current average room rate into 1.15 raised to the power 5, I am not saying that. I am not saying that we have a guaranteed 15% rate growth for the next 5 years. One needs to be cautious. I absolutely respect what you're saying. One needs to be cautious about what is the true price elasticity of demand, and beyond which you will kind of dispossess your customer to a different segment altogether, homestays and stuff like that, right? But I think let's understand where we are today. And also often we think when we look at India, we look at two extremes. We look at the total size of the population, which often excites many companies about the potential of growing their businesses in India. They are disappointed. And then we look at the other extreme of $2,500 per capita income. And again, there's a disappointment there because how many of those people can really afford to check into a hotel where the average room rate is 4,000 rupees? I think I will repeat that for us, the compelling story is tier 1 office airline markets. And I'll explain the reason for that. We realize that India behaves like a developing country, like you mentioned, At the top of the pyramid, and by that I mean, do we sell a Four Seasons hotel for $600 in India? Not yet. Can we have 5 Louis Vuitton stores in a single city? Not yet. So at the top of the pyramid, we do kind of exhibit signs of being a developing country. At the bottom of the pyramid also, we exhibit signs of being a developing country where you can get a meal in Bombay for 10 rupees, right? You can get a great vada pav for 10, 20 rupees, right? It's the middle where there is a massive demand bulge. So if you go to a mall in India, the shirts that you buy, the cars that we all buy, the travel that we are undertaking today, we all understand the price that we are paying is almost reflecting the price that we would have paid for those services and products in a developed country. And that's just because the urban India, both the size and the paying capacity is not diminished relative to many other markets that we talk about. So that's really a more philosophical long-term view. But our rates are not high today. If you see, in a market like Bangalore, which is clearly a lead market for hotel performance, driven by the fact it has 200 million square feet of occupied office space, 200 million square feet, right? In a market with 200 million square feet of occupied office space, I feel elated to sell a Holiday Inn Express for 4,000 rupees, which is barely $50, right? If I travel to Sydney, and please forgive me here for comparing a developed to a developing country, if I go to Sydney, where there is 60 million square feet of occupied office space, nobody thinks twice about buying a Holiday Inn Express for $135. And we are not saying 50 is going to become 135 tomorrow, day after tomorrow, or in 3 years or 4 years. All we are saying is demand supply, the fact that the headroom for growth is for many years to come. Now, whether we can get to a 15% CAGR for 5 years, I would not necessarily give any guidance as far as that's concerned, but we do feel there is little resistance and a lot of headroom for growth for hotel rates in India, especially in large markets with urban customers who have ability to pay comparable prices for other products and services.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I would now like to hand the conference over to Mr. Ashish Jakhanwala for closing comments.
So thank you so much. It indeed is a pleasure to be in a public space. Thank you so much for taking out time to talk to us. We feel really, really excited, and our excitement does not have a very high degree of beta with the market. We are excited about the business that we've created. We are excited about the fact that the locations and the products and the brands that we operate in key markets have a long headroom to grow. We're very excited about the fact that with very little effort in capital expenditure, this company will see almost 17% of its inventory, about 900 rooms, performing to a very different level in the next few quarters. We're also very excited about the fact that we don't need to look outwards to acquire anything, to add 600 rooms to our portfolio to go to about 5,500 room company. So I think with all of that and the fact that the company will start producing free cash from Q3 onwards, we are very excited about the future prospects of Samhi. Thank you so much for joining the call today. And if you have any further questions, please get in touch with us or with Strategic Growth Advisors who support us on investor relations.
Thank you.
Thank you.
Thank you.
On behalf of Samhi Hotels Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.